Good afternoon. My name is Elvis Picardo, and I am a portfolio manager at Loft Financial. The first half of 2022 has been extremely challenging, and I'm sure many of you are probably wondering how we are managing your portfolios in these turbulent times. So, in order to address those questions, here's a short video that tells you how we have been managing your portfolios, what we plan to do next, and why it pays to stay the course. Start with the presentation here. Here's a standard disclaimer. Please browse through it. And now a look at our fabulous team. On the associates side, I'm sure that most of you already know Erin and Zor, but we have a couple of new faces in Vincent and Kareem. What this slide does not tell you is the wealth of experience that we share as a team. Robert and I have combined market experience of over 50 years. In fact, way back when I started my career in 1989 in finance, the Berlin Wall was still standing. So in terms of market upheavals and disruptions, Robert and I have seen them all. And like they say, when you're in choppy waters, it really helps to have seasoned captains at the wheel. So getting right down to it, so far this year, the S&P 500 is down 21%, and the Nasdaq is down almost 30%. Our TSX has dropped half as much, at just over 10% for the year, thanks to its one-third weight in energy and commodities. The main reason for this, as we all know, is rising interest rates, as exemplified by the massive increase in bond yields recently, which you can see at the bottom panel here. We have never seen interest rates and yields rise at such a sharp trajectory for decades. The inflation genie is now out of the bottle, and central banks have to act really fast to put it back if they have to have any hope of controlling inflation, even if that means a recession. As per the latest data, inflation is at a 4-decade high of 8.6% in the US and 7.7% in Canada. Because money is no longer cheap, people are no longer buying up everything in sight. And as a result, you're seeing funds flow out of many asset classes, which are down double digits or more. As you can see from the chart on the left, stocks have been hit especially hard by rising interest rates. And in fact, the TSX and the US indices last week had their worst weekly performance since March 2020. So how do you manage downside risk in your portfolios? Now, bear in mind that it's next to impossible to eliminate downside risk altogether, as long as you're in the markets. But what we can do is cushion some of that market decline. We manage downside risk through a number of ways. By holding US dollar securities in your portfolios, because during periods of stress, money flows to the USD, which is why it's at a 20-year high right now against most major currencies. Dollar strength makes USD holdings more valuable in your portfolios. We also hold blue chip stocks with growing dividends. Names like on the US side, it would be Berkshire, Disney, Johnson & Johnson, Qualcomm, Visa. In Canada, we have stocks like Barrick Gold, CN Rail, Manulife, TD Bank. Good solid blue chip stocks that you can pretty much hold forever, which is why when we see a big dip in them, we just add to positions. It's a buying opportunity. And in fact, as a group, Canadian and US stocks are outperforming the indices by more than 600 points year to date, which is a huge margin of outperformance. On the fixed income side, we're getting about 4% in annual interest income, which is again pretty solid. What we don't hold is stuff like crypto, unprofitable stocks, speculative stuff like junk bonds. So our overall portfolio is very high quality, and we have a yield of over 3%. So that's a good solid number. And as many of you already know, we use a disciplined rules-based process to rebalance your portfolios, because this takes the emotions and biases out of the equation and allows us to rebalance in the most efficient way possible. So, for example, one rule we have is that we must rebalance all portfolios if either the TSX or the S&P 500 is 7.5% away from our last rebalance level. So since our last major rebalance occurred in the middle of May, the next one would happen if the S&P dips below 3,635, or if the TSX goes below 18,250. And again, in terms of an action plan, in the last rebalance, we sold stocks that were either profitable or that were holding up very well, like Nutrien, Pembina Pipeline, Loblaw, and Barrick Gold. And with the proceeds, we bought ones that were lagging, like Disney, Qualcomm, and Platinum Growth Fund. These are all tremendous names with great long-term prospects, and we have very little hesitation in buying them at these prices. So the next rebalance will do pretty much the same. But the point is that over the long term, such disciplined rebalancing works extremely well. You might be wondering if it makes sense to buy equities now with consumer confidence currently near record lows because of inflation, falling stock markets, COVID. Does it make any sense to buy equities? The answer is a resounding yes. So look at this chart from JP Morgan, which shows that it makes much more sense to buy equities when when consumer confidence is at a low rather than when it is at a peak. Their research shows that over the past 50 years, the average 12-month return for the S&P 500 at a sentiment peak, or 12 months after a sentiment peak, is only 4.1%. But that jumps to almost 25% on average 12 months after consumer confidence bottoms out. So the upside when sentiment or consumer confidence is really low, like it is at the present, is huge. So looking at the bright side, there are a few things that bode well for the markets. So the panel on the top shows you that there have been 25 bear markets in the S&P 500 over the last 100 years, or close to 100 years. 14 of them were accompanied by a recession, 11 of them are not. So the average bear market, when you have a recession, is about, you get a decline of about 40%, and it lasts for well over a year. If there's no recession, the average decline is 26%, and it lasts for half the time, about 200 days. So at last week's low, the S&P 500 was down almost 25% from its high, and the Nasdaq had declined 35% from its high. So we're getting very close to the level where almost all the damage has already been done. At the same time, a recession is not a guarantee. I mean, investors are concerned about the possibility, but a recession is by no means a certainty. In fact, a well-known strategist at JP Morgan, his name is Marko Kolanovic, he thinks markets will recover this year, recover all their losses by year end, because he thinks there will be no global recession due to US consumers' strong balance sheet. Remember the trillions of dollars in stimulus that consumers received in the US and Canada? That should support the markets, he thinks. As well, you also have global post-COVID reopening, and you have stimulus and potential recovery in China. So these are all very market positive. To this, we would add the potential for positive shocks, as I call it, and these include a peak in inflation. About half the inflation pressure right now is coming from supply chain issues, and if they get resolved, and if more people get back to the labor force because COVID is no longer a threat, then you'll see some of this, you'll see a possible peak in inflation. As well, we also have soothing comments from central bankers like Fed Chairman Powell. The last thing they want to do is see the economy tip into recession. So they'll do what they can to comfort the markets if things get really dire. And the final positive shock is if we see an end to the Russia-Ukraine conflict. That would be very, very market supportive. Also, let's not forget that valuations are much better now than they were a year ago. The S&P is currently trading at a price-earnings ratio of 16, which is close to its average multiple over the last 20 years. And you can see that in the top panel. So that multiple was as much as 25 times a PE of over 25 over the last 2 years. The bottom panel shows you how quickly valuation has compressed. And this valuation compression with the PE multiple has gone from over 25 to about 16 on the S&P. It's happened at the fastest pace on record, which is again very market supportive. So in conclusion, here's a chart that clearly demonstrates why it pays to stay the course with your investments. If you remember back in October 2008, when Lehman Brothers had just gone under, and it felt like we were on the brink of financial ruin, and it would take decades to repair the damage that had been inflicted upon economies. But what happened? Markets took another 5 months to reach rock bottom, but from then on, we embarked upon the longest bull market in history. In my opinion, the situation this time is nowhere close to October 2008 or even March 2020, when the pandemic first hit us. We think the second half of this year might be less choppy than the first half. And in fact, we think it's quite possible that markets may try to pair some of the declines that we saw in the first half of this year. I do believe your portfolios are very well positioned for a market rebound when it happens. And that brings me to the end of my presentation. Please do contact any one of the Luft Financial team if you have any questions. And yes, please stay tuned for our client webinar on July 19th, where we hope you will all join us. Thank you very much for your time and have a wonderful day.